There's a rationale behind it. I have a button on my soundboard that makes the sound of a ball striking the head pin and sending the other pins flying. It's a lovely sound that never fails to surprise and delight. Last night, Nvidia bowled a strike, and today, stocks of all kinds canned, skidded, vibrated, and rocked in a symphony of glorious sound. The average story was that the Nasdaq was rising, and the Dow was up 6 points from the start of 53%. Nvidia has been having an affair with Apple. At the moment, Apple is competing with Microsoft and the lanes for the title of largest firm on earth. 3.45 trillion versus 3.5 trillion for Nvidia. Apple, you're correct, Apple is the best. There is no doubt about it. Microsoft has abruptly fallen well behind the scoreboard, dropping even more. Last night's Nvidia strike is putting some distance between it and the rest of the field. The numbers are astounding for a company that very few people have even heard of, say, 2 years ago when its market capitalization was only $500 billion. Last quarter, Nvidia generated $35 billion in revenue with a 75% gross margin and a net income of $20 billion. It turns out that a year ago, Nvidia was actually only trading at 20 times forward earnings. These results were so amazing that, in retrospect, they were cheap. This is what happens when a company outperforms the estimates. And as I've told you time and time again, Nvidia has been outperforming the estimates for 10 years. That's the stock that is Nvidia AI. Those numbers are ridiculously great, but they're just a spectacular ramp up. A year ago, a lot of critics claimed that I was ridiculously expensive, trading it at 50 times forward earnings. How did they do it? That's why I've enjoyed it for so long. Oh, Nvidia is rolling 2 balls down the lane: accelerated computing and artificial intelligence. This is all because CEO Jensen Huang and his team may be the greatest bowlers of all time. Figuratively speaking, this morning on Skoo in the Street, my fabulous partner Carl Kendia began the show by asking me what I thought about Nvidia's quarter. At the time, the stock was down a few bucks, and I was silent because I was clinical and didn't want the stock hype. However, I sat back and took a moment, which isn't my strong suit, and I said that, honestly, I've never seen anything like what's happening at Nvidia. Never, just never, even though 19 firms have raised their prices. There are only so many super when it comes to the demand for their technology, and we've heard it called insane and enormous. Last night, the operative bow was in disbelief, and I believe even Jensen was having trouble coming up with analogies when he was discussing how one use for the newest and greatest chip. Targets this morning, I said, is just not capturing the seismic shift that's happening here. Blackwell is OpenAI, which he claimed is something entirely new, much like the iPhone. He said that we think of the iPhone as a once-in-a-lifetime invention, but after listening to the Nvidia call, you realize that, despite the fact that Nvidia chips are revolutionizing the world, there is $1 trillion worth of computing power that needs to be replaced. It's positively Shakespearean. There are trillions of dollars in factories that need to be built with the Nvidia Omniverse, trillions that can be saved in legal work, forecasting, supply chain management, engineering, and most importantly, coding, in which you can simply speak to the machine and tell it what to do in plain English instead of a programming language, trillions to be made in humanoids. And Elon Musk plans to give everyone a human-like robot to do the dirty work, the drone stuff. I've been thinking that perhaps this is Jensen's world, and all the men and women are merely players, or, to use a more straightforward bowling analogy, this quarter was so seismic that it sent entire sectors flying in different directions. Jensen stated unequivocally that power generators like Constellation BMO are a result of our current insufficient power to meet the demands of these devices. The capital markets Brian Ski, our chief investment strategist, is here today and has set an S&P target of 6,700 for the upcoming year. It's nice to see you, and we appreciate you having us. Good morning, squawking on the street you do. Right out of time for some common sense and prudence, and even some humility. What is that about? Well, so many of our compatriots, other strategist economists, love to make the big market call, and they've been just trying to call the market. And I think that they'd really missed that the stock market is a market of stocks, and that's what's maintained our bullish stance, quite frankly and consistently. And some people have called us stubborn since 2009 when we came out with this call that US stocks have entered a 25E secular bull market now. It's tough to be bullish that long, especially given all the negativity in all the doubts. And in your first hour today, you had Mr. Cramer talking about sentiment being still negative. And it's true, and even Tom, the great Tom Lee, earlier this hour, was talking about all the cash on the sidelines, and investors really doubting this, Carl, and it continues. It just baffles me. But for our sense is that the US market, in terms of an equity asset, remains the world's greatest asset. Number one. Number two, you get what you pay for. Too many people are preoccupied with valuation. And number three, when it comes to what we'll be witnessing in terms of our growth over the next 3 to 5 years, it will be consistent. Though there may be other regions of the world that are experiencing, as we pull our clients, we look at other Wall Street research on the financial sector, and we believe that earnings in the U.S. financial sector are massively understated, with a big catch-up trade coming on the earnings front, with the broader theme of scale asset managers, and broker-dealers, scale meaning the big banks, but also very small banks we think can do very, very well. Snapback growth, but in terms of earnings growth consistency, we continue to believe it's going to be the United States. That brings us to our base case, Carl, which is $275 EPS. You kind of trashed the value argument as a reason to exercise caution. So what do you believe is a decent valuation at that point, and when do you start paying attention to it? That's a trap question. Market weight financials, and there's more to come. I appreciate your efforts, Sarah, but I won't offer you a number because I believe that anyone who says, 22 times is the number, it's just basic math. Developing a valuation metric and an earnings estimate is not as simple as navigating the market. Target does not necessarily imply that your approach to market modeling is incompatible with our macro-level approach. Compression of PE and longer-term PE trends, I apologize. But if you look at a dividend discount model, we can definitely reach 6,700, especially given where rates are expected to go in relation to where you look for value-wise. We can discuss that we have been bullish on small-cap stocks for well over a year in print on the published marketplace. Other people also discuss small-cap stocks, so why not look at all valuation metrics, not just PE? PE, price to sales, price to book, and free cash flow operational measures such as return on equity and return on assets. From a fundamental standpoint, Sarah, we believe that small and mid-cap stocks will perform really well over the next 3 to 5 years at the end of trading. These small-cap companies look fantastic, and we're beginning to see more and more expanding out with regard to performance there. Steve, you can play Bitcoin or BTC Grayscale minis in any way you please, Karen. As a long-term investor, I still like Boeing in the G block, just as I did in the E block. Hello everyone, happy Thanksgiving. I am grateful to my family for putting up with me, and they are watching for the first time in a long time. I am also grateful to all of you, and I am not watching anymore. Ali Bob is getting some steam here.